Hello, everyone. James Dobson here, your friendly neighborhood realtor, and today I just want to bring you Toronto's October real estate stats. I think I've only got 10 slides, so I will make it quick. Let's jump right in. First, we have months of inventory and sales to new listing ratio. These are great metrics to measure balanced versus seller's market. So on the left, we have months of inventory, currently at 2.6, which as you can see is just on the boundary of balanced market. If we head any lower, we are going to be heading into seller's market, which is odd considering the market sentiment right now. Sales to listing ratio, we have 41% of new listings sell, which is definitely in buyer's territory, which is giving us conflicting signals here, right? The new listings that are coming on are not selling, but we have so few new listings coming on and so few sales happening, right? Which is giving us this dichotomy in the market. Let's look at some more data and see if we can come to any conclusions based off of this. All right, number 2. Let me move my face out of the way here so you can see this title. Toronto Metro real estate prices. This is just your average price graph over the past, 5 years, it looks like 7 years. You can see that price has come down significantly from the peak. This was obviously when rates began to rise, but you can see that price has tapered off a little bit. And we're going to get into the conversation about where we think rates are going in a little bit, and that's going to have a big impact on where we think price is going in the future as well. So stay tuned. All right. From the peak, this is just another graph sort of highlighting what we just looked at, which is average price. So this is the one that I like to look at. We are down 18% from the peak in February here, and we are down 6% year over year, which all things considered, if you look at what's going on, only being down 6% year over year, I think that's a pretty good situation. However, it could get worse. All right, now for my renters out there, I have a lot of love for you guys, and I know it's been a wild ride the past 2 years. COVID happens, rents drop. People move to lock in a cheaper rate. Now the exact opposite is happening. Landlords are threatening to sell their investment properties because their mortgage payment has gone up so much and they're not allowed to raise the rent, provided that you're in a building built November 15th, 2018 or earlier. That's the rent guideline rule, November 15th, 2018. If your building was built or if you occupied the unit for the first time after that, no rent guideline. That means that you might want to stay away from the newer buildings as a tenant because the landlord can increase the rent however much they see fit with no justification. All right, moving on. And of course, this seems kind of weird. Prices are down and rents are so high. The only way that I can sort of explain this or justify it is affordability, the measure of like income, the average income, average price, and rates has gone down, meaning that it's actually become even harder to own real estate, even though the prices have come down. And you might think like, well, how is that even possible? Rates have gone up more than prices have come down, which has taken a small chunk of the would-be buyers and turned them into renters. And considering that we have a lot of people who are no longer solvent as real estate investors, they're selling their properties as well. So we have a reduction in rental supply, and we have a bunch of new renters as well, which is pushing the price up. All right, next we've got... All right, so this is sort of to me, the first piece of the puzzle when we're looking at, okay, what's going to be happening in the future? Where are prices going? To answer that question, where are prices going, we should first answer the question, where are rates going? And to answer that question, we should answer, where is inflation going? So this is the evolution of the Bank of Canada's inflation forecast. And the important thing to note which is what that gray arrow is highlighting, is that this is the first forecast that has been lower than the previous, which is a sign that people think that we're slowly coming around and inflation might turn and revert back to its 2% target. If that can happen, this should be resolved a little bit as well. So this is a chart showing you fixed and variable rates, and you can see that over the past few months, it's not been a good time to have a mortgage, at least not a variable mortgage. And not a great time to sign a new fixed mortgage either. The reason that these are so high is because the government of Canada, or the Bank of Canada, is aggressively raising rates to fight inflation. So if inflation comes down, there'll be no need to raise rates further, and there'll actually be a big incentive to lower rates, which would incentivize economic growth, which is something that they kind of want all the time. So I don't expect to see these rates sustained at this level, as the historic 10-year average, or even a 20-year average, I think is closer to around 2.5%. So I do expect that, if this forecast is true and we start to see our core inflation dropping a little bit, we could see rates pause or at least decline in the next 1 to 2 years. And let's look at some forecasts for the US, as our market is very similar to the US in terms of what our central banks are doing to combat inflation, as we have very similar inflation problems. So the FOMC participants, which is the Federal Open Market Committee, which is just a fancy name for people who make big decisions for us, what we're looking at here is where those participants, expect rates to be in these different timelines. So we have 2022, which is obviously where we are now. 2023, the average is just slightly higher. So we could expect maybe one more 50 basis points or 75 basis points hike before we're going to see rates come back down. And of course, that's all hinging on inflation coming down. Inflation doesn't come down, rates are going to continue to rise. So they do expect that 2023 probably will be slightly higher, 2024, and then by 2025 we should be back down to this, I call it the mean or the average, which would be around 2.5%. Now, the government often gets it wrong, right? We all saw this inflation thing coming. They were late to raise rates. They're often going to be late to lower rates as well. However, with inflation being high and an impending economic recession, I think they're going to be eager to lower rates as quickly as they can and incentivize economic growth. Okay, I like to joke about this. If you're a government, create a problem, which is COVID. Print out money to fix the problem, causing inflation, the increase of the price of goods and services. Raise rates to combat the high inflation. Those raising rates will push prices down. Last part of the cycle, let in a bunch of new immigrants to buy more stuff and push the prices back up. I know that seems kind of out there, but I genuinely believe that the government is letting in so many people because they want, on one side you have demand destruction through raising interest rates, which means that the same people can afford less of everything because the cost of borrowing money has gone up. So to counteract that demand destruction, create more demand by just adding more people to the country. Seems like a flawless logic. However, an economy that doesn't have downturns is not a healthy one. So I think they're kind of shooting themselves in the foot here, because the whole push is keep a strong economy, get reelected, stay in power longer, which is good. So you have to understand that there is a bit of a narrative to this, and I think that this, letting in this many people, is not going to be healthy, at least for my generation, when it comes to owning real estate. But great for real estate owners, current real estate owners, and if you can't afford to buy, I think it's still an amazing long-term place to store your money. Honestly, real estate has been an amazing hedge against inflation over the long run. Speaking of investments, not so great right now though. And I was mentioning affordability, and that's sort of what plays in here. If we're looking at, okay, first I want to preface by saying, if you are a cash investor, it's never been a better time. As I mentioned earlier, I'm just going to jump back up quickly. Prices have come down quite significantly from the peak, down almost 18% from its peak. And rents are, at least for condos, are at an all-time high. And so if we look at something called a cap rate, which is your net operating income divided by your purchase price, that's actually gone up for cash buyers. However, interest rates have gone up so aggressively that if you are not an all-cash buyer, like most investors are not, your cash flow has been seriously chopped because of those rates. Because essentially we have your net operating income, which is the first portion, which is your rent minus all of your expenses. And the biggest one being your mortgage payment. And if you're variable mortgage, like most real estate investors are, your payment has gone up significantly to the point where now you're actually cash flow negative. And if we do see that other 1.25% increase like they expect, here, going into 2023, we're going to see another little increase with a terminal rate, meaning where they expect the highest rates will go, should be mid 5%. You're going to be deeply into negative cash flow territory if you're taking out an 80% loan to value mortgage at 25 years. 85% LTV just means loan to value ratio, meaning if you buy a $1 million condo, $800,000 of that is going to be mortgage. $200,000 is going to be your own money. And of course, because of the interest payment, you're going to be deeply in the red on that. And going back to why a lot of investors are selling their condos, there's something called a risk-free rate, which is essentially bonds. You buy a bond, you know that if it's backed by the government, there's a very, very high chance that you're going to get your entire principal back plus the interest over all those years, depending on what bonds you buy. And if you can buy bonds for a risk-free rate of 4 to 5% now, why would you risk your money in real estate is sort of the question that investors would be asking themselves now. Anyway, if you want to talk more, I know I could go on and on and on about investments, but not everyone is interested. So if you have any more questions about that, please do reach out and let me know. I'm always happy to chat about investment related stuff. Otherwise, have a great day. I hope to talk to you guys soon.